Welcome to Market Call. Thanks for joining us on this Monday. I'm Morella Fernandez. Chris Heakes is on the show today. He's a new guest. He's Senior Portfolio Manager at Harvest Portfolios Group, and he's going to take your questions today on ETFs. Here's how to reach us. Call us toll-free, 1-855-326-6266. You can also email questions to us, marketcall@bnnbloomberg.ca. Chris, thanks for coming in today.
Thanks for having me. Great to be here.
Kind of a mid-holiday before the actual holiday. North American markets, as you know, have been seeing some new highs last week, especially with some of the ones south of the border moving up. What do you expect for the second half of the year? Will the enthusiasm continue?
Well, let's see. It's been an eventful start to the year for sure. The S&P down 20% at one point and then back up probably over 25% since April. Equity investors, the sentiment's improving. It's great to see. There's more constructive talk around trade policy, and that's, putting some wind in the sails. But, I think we can appreciate it. It's an environment that's changing, on the nose every hour, every time Trump hits the True Social. So let's see what we have in store, from an investor point of view. Being diversified, definitely a way to go to navigate.
You used a good word to describe what's going on with trade. There are constructive talks now, as opposed to just throwing something out there and a comment on, as you say, True Social, and it's just sort of living out there with everybody trying to react to it. You specifically look at ETFs, and I'm just wondering if you've seen reaction in ETFs that totally mimics what's been happening with stocks, or, for example, people at the start of the year moving away from tech into something that they feel is more secure?
Yeah, we've seen that. Like the first kind of hit across the broadside of tech was really that deep seek, and we saw recovery. Then we saw this trade pressure. We saw recovery. Tech is still a huge theme, and we've still seen a lot of ETF flows going into that space. Obviously, it's a huge driver of where we're going, but we've also seen a lot more diversified flows in ETFs. We've seen investors wanting to diversify outside of the U.S. kind of for the first time in a while, so international markets, including Canada. And we've seen investors use other strategies like covered calls, generate income. And so we've seen a little more broadening of where those investment dollars are going. And, we think that makes sense. You don't want to have all your eggs in one bucket when things can change on a dime. Do
you feel like investors are getting sort of more used to ETFs and want to invest more in ETFs versus the market stocks?
100%. It's been a huge trend over the past few years, but it's been accelerating. So even a few years ago, people were saying, well, are we in that 6th, 7th, 8th inning? Well, it turns out we were in the 2nd or 3rd inning, and last year was a record year for ETFs by quite a margin. This year, we're surpassing that. And in times of volatility, a lot of investors look to ETFs to kind of quickly navigate and readjust portfolios. There are power tools. You want to be careful with how you use them, use limit orders. But, when volatility spikes, we see, the usage of ETFs increase, and I think we'll continue to see that play out.
And probably for the next number of years, if you have Donald Trump in office, people are again just looking to park their money maybe somewhere a little more stable.
Yeah, there's certainly that sentiment. So, on the top picks, I know I'm jumping the gun, but we'll highlight, one defensive strategy. That being said, there's a lot of investors who are, very committed to growth. But, I think it is prudent to have a few different things in the portfolio to navigate some more higher growth technology exposures, some more defensive exposures. Let's not forget about fixed income, even though it's challenged too. So, really a holistic portfolio. It's going to be a different answer for every, individual client and advisor. But certainly being balanced, I think, makes sense.
Got it. Okay, we're going to take a quick break. Chris Heakes is joining us today, Senior Portfolio Manager, Harvest Portfolios Group. He's taking your questions today on ETFs. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us on Market Call. Chris Heakes with us on the show today. Let's go to our first caller. Is John from Toronto with his question. Hi, John.
Yes. Hi, Marilla. I always want to tell you I really appreciate your excellent work, so thank you.
Thank you.
Okay. To your guest there, my question on ZWU is if I invest my hypothetical $100,000 in ZWU, what is the downside risk? And that's what I'm asking about, the downside risk. It doesn't seem to have one. It doesn't go below $10. I know there won't be much upside, but has a great dividend, 7-8%. It reinvests in stocks with good dividends. It just seems like a positive story. I'm retired from my TFSA. What is the downside? 7 or 8% dividend is great for me. Thank you so much.
So it's almost that skepticism, right? Like, what am I missing from this picture? So he's right. It's up at about $11 now, and the furthest it seems to have dropped is still above $10. Do you like this particular ETF?
Yeah, so very familiar. I used to manage it actually at my prior firm. Yeah, you can see on the chart there, even in that April meltdown, it's down. Looks like about 50 cents, 60 cents on $10. So not nearly as extreme as the market. It's a diversified ETF, utilities, pipelines, telecoms. So on the defensive side of the ledger, of course, like any equity, it's subject to, pretty significant equity risk, which can happen. So, remind yourself of that. The extra income stream in a covered call strategy tends to help out. Reducing risk a little bit because you're going to collect that. I believe he's correct, 7-8% on this. So, it's a defensive piece in the portfolio. Probably not going to have huge returns. Harvest has an ETF, HUTL, in the same space. You might want to take a look at that. But I think having some defense in a portfolio makes sense, and this is a piece that could achieve that.
So there's nothing overly concerning about this, because I think he was wondering about downside specifically.
Yeah. So let's say, as a hypothetical, if the market was down 30%, and we don't like to talk in these things, but it could happen. Probably this one would be down more in the 15 to 20% range would be my guess. As an estimation, it's much more defensive, but still has some downside. So, just keep that in mind.
Okay, let's go back to the phone lines. Sam is calling us today from Brampton, Ontario. Hi, Sam.
Hi, Marilla. Hi, Chris.
What's your question?
My question is on XDIV.
Do you have a specific question about it?
Yeah, I just want to know if this is something that you can hold in your registered account and just live off the income.
Okay, thank you for the question. Are you familiar with this one?
Yes, it's a quality ETF, both literally and figuratively. So it's a good ETF. So it's a low fee, tracks an MSCI index that gives exposure to high quality companies and dividend-based companies. So again, a little bit on the defensive side, but it's more of a core strategy, whereas the utilities ETF was more of a sector strategy. So core strategy with a quality tilt. I think that's pretty reasonable for an equity piece in the portfolio, and you can see it's done quite well. Canada in general is doing quite well, and so we still like having a little more balance in Canada these days versus what we might have said a year or two ago. So this is an ETF that can benefit from continued outperformance in Canada.
Can you give me an idea of some of the stocks that would comprise this ETF?
Without knowing exactly, I would expect it would be high quality, bank stocks, probably some pipelines and kind of blue chip dividend payers. Perhaps some industrials, like some railways as well.
Okay, so if you are advising somebody on which ETF works for them, what kind of information do you need to gauge from them first?
Yeah, for sure. So, the know your client is a number one, but when you kind of nailed it down and you're kind of closing in on what Canadian ETF makes sense, the devil's really in the details. You gotta, there's so many options out there. Every kind of choice along the way is going to change the portfolio at the end of the day. So, you want to do that, look under the hood and see not just what's performed better over the past year, but what construction do you think makes sense? In this case, the MSCI. It's I'm familiar with their factor indices, and they do, provide balanced and good factor indices. So I'm pretty confident in this one. But you want to do that due diligence to make sure you understand what you're looking into.
And out of curiosity, do you find a lot of the people who want to get into the ETF side are people who want the steady income, meaning they're past their working life and they're retired or getting close to retirement?
A lot, yeah. I think it's kind of a barbell. A lot of younger investors and a lot of older investors who, have a little more time and a little more money to invest as well. Both have been active users of ETFs. So,
yeah. You're getting a mix. Got it.
For sure.
We're going to take a quick break. We're going to stick around with Chris Heakes. He's Senior Portfolio Manager, Harvest Portfolios Group. He's tackling your questions today on ETFs. We're back in a moment. Welcome back, and thanks again for joining us. Let's go right to your phone calls. Tyler is on the line. He's calling from Thunder Bay, Ontario, with a question. Hi, Tyler.
Hi there. I'm wondering what the guest's opinion is of the Vanguard Dividend Appreciation ETF. I think it's BGG for CAD. What do you recommend it for core holding? Thank you very much.
Okay, thank you for the question. Vanguard.
I would, it's a good core holding for the U.S. Now, one thing I would just say on this one, it's kind of branded as dividend appreciation. There's quite a bit of tech and kind of core in there as well. So I think, given that the index is quite heavily tech in the U.S. these days, it's a good fit. But if you're thinking of it as a real defensive play, as you can see, it took on quite a bit of downside in that April drawdown. So, just being mindful that it's going to have a risk level probably of close to the broad index. It's not as defensive as you might think, given its dividend, but I do think it's a good core holding.
So you'd have to have a higher appetite for that kind of risk.
You would have to have a higher appetite. And if you thought maybe you had a growth ETF and you were balancing it with a dividend ETF, I wouldn't say this is the one for a defensive value.
Is there something else you'd suggest?
A Harvest ETF, HBF brands. It's more of a steady Eddie type of exposure. Doesn't have as much downside, doesn't have as much upside, but that would, for example, be a good complement.
What's included in that one?
So it's mega cap, 20 very mega cap stocks within the U.S. market. A mix of diversified across sectors, but less tech, a little more kind of Main Street economy type names overall.
Got it. Okay, let's go back to the phone lines. Joe is on the line. He's calling from Montreal with a question. Hi, Joe.
Hi, I want to ask your guest about a recommendation for a senior's cash account, a dividend ETF that would take into account, like, is it better to go Canadian, global, international, something that will weather the storm between the U.S. and Canadian tariff situation? And do you have any recommendations for me? Thank you.
Okay, thank you for the question. You mentioned that people are now looking abroad for that exact reason. What have you been recommending?
Like international. International, we're going to talk about a top pick, but international broad equities actually have a pretty good dividend yield. So we're going to talk about one later in the show. That's THE. Within Canada, I do like the ZDV, which is another one I use to manage. That's a good complement there. Pretty defensive. I do like the composition of the Canadian market. I know there's a lot of noise. Obviously, we're going back and forth, kicking that ball with Donald Trump, but very blue chip overall, and bullish on that. So that would be one that can be played. HLIF is a Harvest product that's got a little more income, a little bit less risk. And so those are a couple ones I would look to for a dividend ETF.
You mentioned people are looking more sort of outside. Is it generally Europe that they're looking to, or they're going towards, Japan, or they're going towards India? What are you seeing? Seeing
all of the above. Japan, there's been a bit of headline risk recently with a kind of one of those yield tantrums in the bond market. So there's a little bit less appetite there. I think emerging markets is starting to get a little bit more interesting. There's a little more interest in China, and India has always been kind of the crown, kind of one of the more crown jewels of the emerging markets market. but for good reason, and there's a lot of growth that can happen there. So yeah, I like emerging markets as part of diversifying. It's a smaller way to your portfolio. I think the U.S. community, they're more going to international markets, but maybe not looking at Canada as much. But Canadians, I think we are looking at all the above, including Canada, and for good reason. Canadian equities are offering quite a bit more value at this point in time.
Got it. Okay, let's go back to the phone lines. Terry's on the line, calling us from Thunder Bay, Ontario. Hi, Terry. Hi, Terry. You still there?
Hello.
Hi, Terry. Yep, go ahead.
Yeah, my question's on XEI. I used to own this. I see there's a double top now, so I'm waiting for it to come down. Do you think there's a possibility of that? Thank you very much. Okay,
let's pull up the chart for XEI and have a look at what he's talking about there. So it did that same April stink that everybody else did. What is this ETF comprised of?
Yeah, so this is Canadian high dividend issuers. It's a good ETF. You can see it's above those highs. That's kind of the same of what we're seeing in Canadian markets in general. Like the U.S. just got through that all-time high yesterday or on Friday and today. Canada's actually kind of blown through it a little bit more. So you're seeing that with Canadian ETFs. Are we a little bit ahead of the skis? Is there a pullback? I think there could be some reasons, why. We've got Trump, his trade policy is kind of expiring July 9th. There's this, he's certainly been a lot more constructive than he looked at the beginning of April. But at the same time, I think there's a possibility for some noise. So we'll see. We'll see what that brings. Perhaps equity investors are getting maybe a little jubilant in the short term. But that being said, if you're a buy and hold investor for a long period of time, I think you can kind of hopefully look through the news a little bit. I think the deals are going to get done. It's just going to be a choppy path to get there, and this could be an ETF to give good Canadian dividend exposure.
Yeah. Pushed deadlines for different countries. Some countries are just, I think, going to get told, here's what the rate is, and there could be some back and forth there. So yeah, it could take a while to shake it all out. Let's get to one last caller in this block. John is on the line. He's calling from Markham, Ontario. Hi, John.
Hi, Morella. Good afternoon to both of you. I'm looking at trying to find, I'm in retirement, and I'm looking at trying to find something with income. And you don't see a lot of information out there, product out there related to preferred shares. So I'm trying to find almost an equivalent to a fixed income kind of product that gives some distribution, monthly distribution. And I'm wondering, are you aware of any preferred share covered call ETFs or something similar out of Canada?
Okay.
Thank you.
Thanks for the question, John.
Yeah, I don't think there's any preferred share covered call ETFs. One of the things you need to do a covered call is you need a little bit of volatility on the underlying, and that volatility will provide the extra premium. But if the volatility is a little on the lower end, it can be difficult because after trading costs and expenses, there might not be a lot left over.
Sure.
So for that reason, and the other thing you want in a covered call overlay is really strong liquidity, and the preferred share, it's quite a small segment of the market. If one were to look at preferred shares, I would just take the broad market of the Canadian preferreds, which would be CPD, would be the iShares ticker for the broad market. To be honest, I'm not super keen on the market overall. I think from an active perspective, there might be a couple products out there where they can be a little bit more nimble. So that might be something to look. I don't have a recommendation for that, but from an ETF point of view, maybe a little bit of CPD. But if you're just looking for income and maybe mixing some equity covered calls with some fixed income, maybe that could do the job just as well.
Got it. Okay, we are going to take a quick break. We'll be back in a moment. Chris Heakes with us. He'll take your questions on ETFs. Stay tuned. Welcome back. Chris Heakes is with us today. We're talking ETFs. One thing you have noticed is income option ETFs are growing. Tell me why you think people are so interested in that and what else you're noticing.
Yeah, well, my ETF career started kind of just coming out of the financial crisis, and one of the big themes was the search for yield. It was, so everyone was searching for yield, and it turns out no one stopped searching. So, Canadians love their income. So cover calls can provide that. They're also typically going to lower the risk as to, the basket that you're doing it on. It'll lower the volatility a little bit. So taking a little bit of risk off the table, providing more income, it's a good fit for a lot of clients. And we're certainly seeing a lot of interest in that domain.
You also talked about just ETF growth in general. That you're seeing every year on year, more people joining that. Why do you think that is?
The ETF has a lot of advantages. It's been lower cost. It's been, I think, probably, and you could debate this, but more innovative, in terms of getting ahead of the curve and offering investors exposures to things that were previously not available to them. So innovative, lower cost, tax effective as well, and give users just a great tool to control what they're investing in and how. Like I said, in times of volatility, it can just become, quite simple to move in and about ETFs. In some cases, they even provide additional liquidity, that you won't even find in underlying markets. So some investors have taken advantage of that. So all being told, it's just all kind of together created a kind of fertile ground for that.
Are people going more towards sector specific? And if so, what sectors? You mentioned, for example, maybe defensive more this part of the year because of what's going on.
Yeah, so, it's across the spectrum. ETFs started as broad market. Canada actually had the first ETF in the world, right, which tracked the TSX. I believe it was 30 top companies in the TSX. SPY, which is the U.S. S&P 500, followed quickly thereafter. So a lot of users use broad beta, low-cost ETFs. A lot of ETF users use sectors to dial into this particular market, or they dial into, maybe it's not easy to hold European stocks, so you can get, obviously those vehicles through an ETF very well. And then you've got covered call ETFs, which are, more of a unique strategy that is difficult for individual investors to replicate at home. So it's that whole, gamut across the board from broad beta to sectors to more kind of outcome-oriented strategies.
People just want different exposure, I guess, than just what they were offered with one stock. Okay, I do want to get through a couple of emails in this block as well. The first one comes from John. He says, could I get your opinion on the ETF TXF? Tell me about this one.
TXF, so it's a CI technology ETF. Really just large cap technology. As you can imagine, it's done, very, very well over the past, kind of few years.
Sure.
It's a high quality ETF. You can see, obviously, like other technology exposures, has had a, bit of a drawdown in April. It's still on its way back. Kind of surprised it's not back to that level it was. Part of the reason might be it also uses a cover call strategy. So this one will pay out a variable distribution, however much premiums it collects, it'll distribute that out. HTA is another one that Harvest offers that, is more of a consistent dividend policy. It might be another one to look at, but definitely having some technology, makes a lot of sense.
Got it. Okay, let's get to another email from Richard. Your guest opinion, he says, on iShares short Treasury bond ETF as a place to park some American dollars.
Yeah, so I think he's referring to the SHV that's traded in New York, and it's a very good ETF. It's a very straightforward ETF, short-term U.S. Treasuries. They offer a pretty reasonable yield. Were you to look to hold that exposure in Canada, and maybe we can talk about Canadian U.S. ETFs, but, Global X has one, ubill.u. Basically the same thing, just trading in Canada. That might reduce some operational kind of tax filing type issues, because sometimes when you hold the foreign property, it requires a little more in terms of, maintenance from that point of view. But so that'd be another one to consider.
Are you worried about the one big beautiful bill, which is going to put a tax on wealth generated by Canadians in America, for example?
Yeah, so I guess it's still kind of coming through that final run.
Yes.
It looks like they took out the most kind of
Penalizing?
Penalizing, prohibitive, from, holding equities and generating dividend. They're talking about increasing the withholding tax pretty substantially. This was a revenge tax, right, as it was labeled for the digital service tax, which is now not here. So, it looks like that's settling down. Obviously, lots of issues for those two governments to work through. But, the big, beautiful bill, the bigger concern with that bill, I think, is just this idea of the U.S. is spending more and more. It's quite expansionary. Elon Musk has been pretty vocal critic of it, but, a lot of critics of, just how far can we go with the spending. So you're seeing a little bit of noise in the bond markets where they've been a little more concerned about, the magnitude of spending that's in this bill.
Got it. Okay, we are going to take another quick break. We'll line up some more phone calls for Chris. We're back in a moment. Welcome back, and thanks for joining us. Let's go to the phone lines. Rakisha is on the line with a question today for Chris. Hi, Rakisha. Rakisha, you there?
Oh, hi.
Hi, what's your question today?
Yeah, my question is on Harvest Healthcare Leaders, HHL. It used to trade about $8. Now it's trading like $7 to $7.25. It's mainly for the income. What's your guest opinion for like 5-year hold?
Okay, thank you for the question. We'll see if we can pull up that chart. And this is healthcare based?
This is U.S. healthcare, yeah. So
which is taking a bit of a
to say the least, super unloved sector. This is my boss manages this, so I'll have to be careful. No, what I say.
What'd you say?
But healthcare. This is a signature healthcare vehicle in Canada. It's one of Harvest. It is Harvest's largest ETF. Healthcare thought of generally has been a great diversifier for Canadians. We don't have a healthcare sector in the TSX really much to speak of. And this is 20 top U.S. listed healthcare companies. The market cap of these 20 companies actually exceeds that of the entire TSX. Yeah. So it shows you the scale. But with Trump and RFK and drug
and
pricing,
the cuts that they want to make and the changes they want to make, is that what is feeding into the lower share prices?
100%. Yeah. So a lot of negativity, and when NASDAQ and technology is kind of flying, kind of sometimes other things kind of get left behind. But what we are seeing here is there's a lot of volatility. So when we do the cover call overlay, it gives us a lot of tools to generate additional income. We have seen more inflows coming into this product. As investors are saying, well, maybe the negativity is a bit overdone. We're seeing a little more interest, more positive inflows, and that's great to see. When you see positive inflows into a sector that's hurting, I think that's often a good sign.
Got it. Okay, let's move on to another caller then. We have Peter on the line with a question. Today he's in Ottawa. Hi, Peter.
Hello.
What's your question?
Show.
Thank you.
Yeah, I'm wondering how common or how many ETFs would include BCE as a holding in the ETF?
Okay.
Thank you.
Thanks for the question. Are there telecommunications-specific ETFs or some that include all of the telecommunications companies?
There are some telecommunications. They're in some of the utility ones we mentioned off the top that include telecoms as well. It's a great question. I think there's something around 1,400 ETFs in Canada, so there's a lot of slicing and dicing. That's a great question. I'm curious how many would include BCE. Quite a few, but you're going to get many of the dividend-based ones. Mm-hmm. Now BCE cut their dividend, so some of those dividend ETFs may have ejected the BCE. One thing that was nice to see was when the dividend was cut, it rallied. So we're hanging around this $30 mark. But a lot of ETFs would include it. One thing in covered call ETFs, BCE was traditionally a very low volatile stock. Well,
yes.
It's a kind of more of a high volatile stock
Absolutely.
now. Yeah, so can offer something from that perspective. But yeah, no, it's widely held stock, but one to be a little bit careful with as you look at that price chart. And
yeah, so BCE, of course, we have to remind people, parent company of this, the channel under the Bell Media brand. Let's move on to another caller. Neville is on the line from Ottawa as well. Hi, Neville.
Hey, good afternoon there, Morella and Chris. I had a question. With all of the talk about defense increased spending, I've been looking into ETFs in the defense area. There's one that caught my eye. It's the Global X Defense Tech ETF, SHIELD. Chris, do you have much information on that ETF?
Yeah, great ticker. Sometimes in ETF world, we like having, marketable tickers. So SHIELD, it's a great ticker. So this is quite a large ETF in the U.S. I believe Global X just launched the Canadian version, maybe in the last couple months.
Okay.
Yeah, we call this a thematic ETF, a way to play the theme. I think that, for better or worse, I mean, there's no question this is going to be a big theme if we have this GDP spending, to
5% for
5%.
NATO. Absolutely, everybody's moving that way.
Yeah, so this one would be poised to benefit. Another one in the U.S. There's a European focused one, and I believe the ticker is EUAD. So that's another one that's kind of Europe specific. Shield is more North American listed, so probably a little more on the liquid side. I think it'd be a good ETF to play this theme.
Got it. Okay, let's get to one last caller. Rob's on the line today from Calgary. Hi, Rob. Rob, are you there? Do you have a question today, Rob?
Hi, thanks for taking my call.
Go ahead.
I'd like to hear Chris's opinion on HMAX, the Hamilton's Canadian Financial ETF. Would he recommend this covered call ETF for an investor looking for income, or do you think it would be a better strategy to split it between HMAX with a covered call and a non-covered call ETF in the same space, such as BMO's ZEB? Thanks again, and happy Canada Day.
Thanks very much, Rob. Okay, so let's talk about HMAX first. Tell me a little bit about it.
Yeah, so this is covered call strategy, very high yield. Now, like with covered calls, there's this trade-off, right? You can generate income, but the more income you generate, you tend to have less upside. So this one would be on the high income, but certainly less upside as well. And I think that's what's, the caller is getting to with this question is, well, should I have some more upside with a strategy that doesn't use covered calls? So I say in general, think about what you're trying to accomplish.
I was going to say, how do you differentiate what if he's accomplished? What does he need to look for to go one way as opposed to go the other way?
Right. So like, what's my risk tolerance? What's my time horizon?
Timeline, yep.
Time horizon. If it's in excess of kind of 20 years, maybe you're a little more on the equity side. You tend to have total returns that are a little higher, potentially in the ZEB. But if you're kind of want more income, a little bit less risk, then you can skew more to the cover call. But yeah, so this one is it's a large ETF, but quite a high distribution yield. Maybe a touch too high in my opinion, but.
It depends on the timeline is what it comes down to.
Yeah, but Canadian banks have been doing well, and I think we'll continue to do that. So, but great question. And I think every investor has to sort out for themselves, how much cover call, how much equity, and what makes sense.
Got it. We're going to take a quick break. We're going to come back with Chris Heakes taking your questions on ETFs. Here's how to reach us. We're back in a moment. Welcome back. We want to go right to the phone lines. Kevin has been holding on the line. He's in Toronto. Hi, Kevin.
Hi there, Morella. Thanks very much for taking my call. Chris, I'm looking at the Harvest Premium Yield Treasury. It has, it's like a pretty high 19% yield on it. So can you give me your thoughts on that? Thanks. Thank you very much.
Okay, so it started moving down last fall. Do you know why or what triggered that and what your expectation is?
Yeah, so this ETF holds longer-term bonds, think TLT, if you're familiar with that ETF in the U.S., and does a cover call on longer-term bonds. Now, like I kind of alluded to a couple segments ago, bondholders in the U.S. have been very much kind of challenged. Two key issues. One was, inflation, and still, the thought is we're not super worried, but, they're waiting to see does inflation kind of filter through over the summer. They've been worried about that, and they're worried about the expansionary kind of nature of the U.S. spending path. And that's put a lot of pressure on long bonds. So, it's a good reminder that long bonds they almost act like equities from a volatility point of view. So they've been under pressure. This ETF's been under pressure. It's got a very high yield. One that we've been talking about a little bit more, rather than the long bond, is a midterm bond, HPYM. Okay. Has less duration exposure, so less day-to-day volatility, less yield, but still, a nice yield pickup relative to just the treasury yield of a 10-year of 4.3 or so. So that's one we've been talking about a little bit more. But at the HPYT, happy tea, as we call it. Yeah, hasn't been so happy, but let's see. You know, if we do get some constructiveness, could potentially, you know, put some wind in the sails. It's been sold, but, you know, it's been choppy for that one.
What's the yield for that one?
Roughly? I believe it's around 17.
Okay, yes, he did mention it was a high yield, so I was just wondering where it was at. Okay, yeah. Good to know. Let's go back to the phone lines. Devish is on the line with his question. Hi, what's your question today?
Good afternoon. Thank you for taking the call. My question is for non-registered account. Which one is the better choice when holding in the ETF is the same, like listed in TSX CAD or those listed in New York Stock Exchange, which is USD? Example is Tech listed in TSX, NER 0.39, or VGT, Vanguard Information, that is NER 0.10. Apart from the basic factors like NER and exchange rate, what are the other factors should be considered for better growth potential for a fewer tax implications? Thank you.
Okay, so a lot to pick at there, but if you're looking between Canada and the U.S., what do you need to know?
Yeah, so withholding tax, we talked about that. You know, and whether you're in Canada with a Canadian ETF or buying U.S. stocks, you're still going to, you know, most cases be impacted by that. So, you know, there's no kind of workaround by using it. You know, the Canadian ETF will typically pay the withholding tax at source, so you get the net distribution. And same thing when you buy a U.S. stock. You know, your broker will pay you the net of withholding tax dividend. So you're going to pay that regardless. You know, a couple things to think about is, you know, FX conversion costs. You know, that's something to keep in mind. Cost is always important. Withholding foreign property, there can be a little more forms to do when it comes to tax season. You know, if it's over a certain amount, there can also be, for high net worth, estate tax implications as well. So that's something to consider. And, you know, a little outside my realm of expertise exactly what those limits are. But, you know, they do create a little extra burden. And so a lot of times a Canadian ETF could be, you know, just as efficient and a little more simpler.
Got it. Let's go back to the phone lines, and Gulan's on the line. She's in Toronto. Hi, Gulan.
Hi there. My question is on HMMJ. I bought that quite a few years ago, and since then it's done a reverse split, and it's at a 52-week low. Should I just sell it and take a tax loss on it, or is there any hope for it going up a little bit? I'd appreciate your opinion.
Okay, Gulan, thank you for the question. Are there a lot of marijuana ETFs?
Not a lot.
Okay.
This was, I think, the original one in the space and was quite notable when it first came out. And the theme was very hot. You know, the theme has somewhat, you know, gone up in smoke, you know, to pardon the pun. But, you know, so, you know, this is the great thing about ETFs. If you have a real conviction on a segment of the market, there's probably a segment you can find to deliver that, you know, on that conviction. If you don't have the conviction, you know, I would suggest perhaps the tax loss might be more valuable, move on to something a little more productive. But yeah, I'm not an expert in the space, but I just think it's, you know, it's a space where you've seen a lot of new entrants. There's a lot of competition, you know.
Is it oversaturated, do you
probably,
think? Yeah.
You know, that's my observation.
So maybe cut your losses and look for something else.
I would.
Got it. Okay. Let's move on to another caller. Joe is on the line. He's in Thornhill today, Ontario. Hi, Joe.
Hi there. Thanks for taking my call. Yeah, I was thinking about adding QMAX to my TFSA. I noticed it's got it's very high yield. None of the stocks in the group really pay much of a dividend. I'm just wondering if that's sustainable. Are you getting any return to capital? Or anyway, just general thoughts on that. Thank you.
Okay, thank you for the question. QMAX.
Yeah, QMAX, so another Hamilton ETF. So yeah, it's a technology-focused ETF that's doing covered calls, and that's where the majority of the income is coming from. It's not, you know, dividend yields are quite low on the basket, but option yields are quite high because the volatility is high in the technology sector. You know, it's again that probably one that skews to higher income, a little bit less growth. You know, we talked about some alternatives, you know, the space. HTA is the Harvest and, you know, Lipper award-winning fund, a little less income, but probably better growth without kind of taking a look at it. But yeah, so that's what you're getting with QMAX. You know, is it sustainable, the income yield? So like we'll see. And return to capital, you know, that can happen for any number of reasons. Doesn't mean it's just being an over-distribution. It could be that, you know, you're selling option premiums, but if stocks rally, you have to buy them back. That can create a tax loss, and then that can go create ROC, you know, when it offsets against other gains in the portfolio. So that's a big rabbit hole to get into, but yeah, if you like technology and income, you could look at this one.
Got it. Okay, let's go to, I think will be our last caller here is Corey from Merrittville. Hi, Corey.
Hi. I was wondering your thoughts on Hamilton U.S. T-bill yield max ETF, which the ticker symbol is H-bill. Seems to be a low volatility, 7.5% yield if there's much downside risk to it. I'll hang up and answer. Thanks.
Thank you. So Hamilton's U.S., I guess this one is. Do you know much about it?
I thought I did, but this one, maybe I'll take a pass on this one. I'm not sure if they're doing a covered call in this one, and maybe that's where we're getting the income, but...
Okay, so we'll leave that alone. Okay, we are going to take a quick break. We have some top picks coming up from Chris. We're back in a moment. Welcome back. Time now for Chris to share his new top picks. We're going to start with TD, the International Equity Hedged Index. Why do you like this one?
Diversification. So, this could be a pretty meat and potatoes top picks, but, it's a good reminder that about a third of the developed equity market is outside of North America. Mm-hmm. And so this is an ETF, pretty simple, pretty low cost, tracks an index that, is ex-North America developed markets. And, performing quite well. See very strong recovery post this April sell-off. But a good reminder, for Canadians and their portfolios, it's more than just Canada, it's more than just U.S. I think it is a time to take a look at that and potentially add some international diversification. This is a broad market ETF, so you're not getting huge kind of skews in this. It's just a well-diversified, I believe, 900 holdings or so in this ETF.
If you are an investor, what kind of investor should look towards this ETF? Yeah,
so this would be a portion of your equity allocation. So if you were 60-40, you could have, 10 to 15%. Perhaps, in this international ETF, and chose the CAD hedged one. The unhedged one is quite a bit bigger, but with the European currencies and the Far East currencies, often it's better, I find, for Canadians to just hedge those. They don't really offer a huge diversification benefit. There have in the past been some existential risks with those currencies from time to time, so prefer the hedged on this one.
Got it. Okay, let's get to your next top pick, which is a CIBC pick. It's the active investment grade corporate bond ETF. What do you like about the corporate bonds?
Again, meat and potatoes. So this one focused on investment corporate bonds in Canada. This is an ETF that's actively managed, but at a very reasonable management fee. So it's not overly expensive at all. And a long track record. And, a reminder, I think, that, there's a lot of attractive yield options out there, certainly with the covered call space, but still having fixed income and high quality fixed income, I think, is a great, place to be in this market. And, again, this is just an ETF that's going to give you probably mid 4% yields. Nothing crazy, but high quality, and can be a part of that kind of 40% on the fixed income side if you're that 60-40.
What's the range for the management fee? Because sometimes you're like, this has a low management fee, but what could be the range for people who are starting out in ETFs?
Yeah, so they're as cheap as kind of 5 basis points on broad equity indexes, maybe even a touch under that now, which is almost free in some sense. I believe this one is 40 basis points, which is quite low for an active ETF. We're seeing some active ETFs are could be closer to 1% or more. There's one point in time where fund companies were charging kind of close to 2%. And that's okay, but you better be adding value if you're charging those types of fees. And that's part of the reason why a lot of investors have gone ETFs for, kind of a more reasonable fee level.
Got it. Okay, let's get to your third pick, which is a Harvest Low Volatility Canadian Equity Income. So low volatility implying, of course, that you're not taking the same kind of risk. What is in this ETF?
Yeah, exactly. So looking for lower risk companies and sectors overall. This would be part of what we would call factor investing or smart beta. Just taking an alternative weighting versus the market cap. One that's near and dear to my heart from my previous shop in managing this strategy. It's really about a sleep at night kind of blue chip portfolio. This one adds an option overlay as well to low volatility. So it's Canadian equity. Think of banks, railways, pipelines, some defensives like Dollarama, Fortis, Couche-Tard. Just a really well-diversified portfolio with an option overlay for additional income. So, think it makes sense to, again, be a little bit prudent with everything going on.
And timeline, if you're an investor looking at this fund, what kind of timeline would you want them to have if they're looking this direction?
Timeline in terms of holding the ETF, you know, like this is to me, this is a part of a core Canadian equity allocation. You know, the way we structured this is we don't, you know, some of the low volatility ETFs out there take really big sector bets. This one's more core. So to me, this is just a core buy and hold. We also have one without the covered calls that would be also more core, higher total returns over time if that's the approach. But, you know, the HVOI really designed for probably, on average, a little bit of an older investor with a nest egg who wants more income, a little bit more defensiveness. And, you know, a lot of the names in this portfolio, they're going to be there for a long time. So we hope our investors will be there, too.
Got it. Okay, we have to leave it there for Market Call. Chris, thanks for coming in. Appreciate you joining us. And thanks for having your first time out with us and coming in just ahead of the holiday. It's always hard that time. But thank you for that. And we are going to leave it there for Market Call. Thank you for joining us today. We'll see you again for the next Market Call. Here is a look at the markets as we head to a break.